All right, good morning and welcome to Web3 Wednesdays, where we chat through some of the complex and nuanced topics in crypto and Web3 at large so that you can stay ahead of the curve. So today I'm joined by Carl Hua, CTO and Investment Partner over at Shima Capital, an early stage VC firm that targets disruptive crypto and blockchain technology companies. They've invested broadly across the space with holdings in gaming, DeFi, infrastructure, and broad DAO entities. So Carl himself, he has a well-decorated past where he previously led research and development at Ripple's open source business unit. He was the chief architect at Celsius Network, and he was the CTO for Logos Network. All of that is in addition to contributing to real-time flight software for NASA at JPL in a previous life. So Carl's experience across the space in both building and evaluating, these financial machinations and technical components of early-stage ventures in crypto make him a fantastic research for learning more about how we should be considering these big ideas like staking, valuation, and key product performance indicators. So we're keen to get his takes on the matter. Carl, welcome to the show.
Yeah, thank you, Sam, for having me here today.
All right. Well, awesome. Well, we are really excited to hear what you have to say here. So let's dive right into it, chatting around staking. So staking, right, for the listeners, very controversial topic, okay? On one hand, it was super effective for bootstrapping user growth and decentralization back in the early stages of DeFi. But on the other hand, staking is getting a lot of criticism around, users claiming that staking is just an outdated mechanism that increases hyperinflationary pressure. It basically just destroys the value of tokens for those who choose not to stake. So, in that context, with those two separate framings, how do you view the utility and position of staking today?
Yeah, so if you think about staking, we have to take a step back and kind of review how staking was invented in the first place, right? So this predates DeFi, and when Bitcoin first launched, it was proof of work, so which meant there was no proof of stake type of mechanism to secure the network. The downside of proof of work really is that it was not scalable, because that's actually one of the core attributes of proof of work is anyone can come online, provide the proof of work, which is the mining part of the system, right? And then provide proof that they are the legitimate next block, right? Whereas then proof of stake came around. So the whole idea of proof of stake is the more stake you have in the network, the higher the reputation is, and that directly translates to validation power. So before DeFi came around, staking and proof of stake really was used for security reasons, because imagine you own 1% of the network and you've staked your tokens, and then you're able to validate the transactions under the condition in which you lie or cheat the network, and you provide invalid transactions to the network. You then in turn get slashed, right? So it's a mechanism in which the networks themselves to gain an acceptable amount of security over proof of work. Now, DeFi came around shortly after Ethereum's launch, and what we saw was some of these protocols, DeFi protocols, also had staking. They are decoupled from the security aspect of the network. Now, if we take a step back and we look at this, is staking more or less is designed and implemented to secure some type of protocol, and in DeFi, that's no longer the case, right? Most of the DeFi protocols are using staking as a reward mechanism. And once you kind of decouple the underlying needs for staking and it became a reward mechanism, you will find issues with that, because then we kind of have to think about this is what's the purpose of staking now, right? And many of the DeFi protocols using staking to reward the end users, which then creates this thing where, well, now I'm getting more of the underlying token, and the protocol themselves are actually selling future upside of the protocol to kind of gain the user adoption in exchange, right? So we can more or less view this as a way for the protocol to incentivize adoption in exchange to provide this type of staking. So there lies a very subtle difference between proof of stake network and DeFi staking, and hence the controversial effect there, right? So if you look at a lot of DeFi protocols, when they perform the staking, it's usually that you get rewards in exchange. So it doesn't provide any additional security. So it's questionable how sustainable these type of mechanism is.
Yeah, I think that's a great framing of the situation, and I completely agree, right? It's bifurcated into something that started with really severe utility, like underwriting a network, making sure the network is secure, propagating transactions, and now it's moved into marketing spend, effectively, right? Like we are effectively purchasing users.
Yeah, and it was super effective when I remember when Sushi Swap came around. They did a vampire mining, and then you were able to stake Sushi tokens and get additional rewards. I think as this becomes more adopted, such model, it becomes less and less effective, right? And one of the side effects of that is it usually sends these projects into something called the death spiral once the token price drops to a certain level and the users kind of lose their confidence in the project. Well, one argument is if you believe in this project, you stake the tokens, even though it's not security related, you get rewarded for not spending the tokens, and you reduce the token velocity and so forth. And in exchange, you get a little more of the tokens. And when the project gets adoption, so what happens is these tokens are usually the governance tokens, and it has real utility to the project, but they're essentially fighting against the adoption curve, right? Because if they're not able to gain sufficient adoption for the project, then the token price will decline, and that gets them into a death spiral type of situation.
Yeah, and I also love that you went there with it next, because my next set of questions was going to be around lock periods, right? And so a lot of projects, they are conscious of this idea that people who will receive these token emissions will probably just sell them, right? They're mercenary capital, mercenary consumers just coming in to scrape a couple, bits of capital off the top. So there's this idea of locking periods within staking programs now. Popular ones like Alluvium, right? You can't receive your rewards for a whole year afterwards, et cetera, things like that. Have you seen, any really convincing models in the space right now, any interesting locking mechanisms that you think might actually do a better job of aligning user utility with platform utility in a way that, it makes staking a little bit, maybe not a rote excellent thing to do, but like maybe a slightly better idea to do?
Yeah, I think this goes into type of thing. It has to do with the tokenomics design of the underlying protocol. First and foremost, if a project can tie utility, and we were talking about massive amount of utility that outweighs the benefit of dumping the profitability of dumping the tokens, then we would argue that it's a viable solution to such programming, right? For example, one of the projects that I like a lot is Curve, even though by no means they're perfect, right? I think we're still very early on. Ethereum was launched in 2015. And most of the DeFi projects are less than 4 or 5 years old, right? So it's very early on. It's not a solved problem, but I think Curve does a very good job in incentivizing the community to lock up their governance token. So what they do is actually, the longer period that you lock your tokens, the more voting power you have in the ecosystem. And Curve I would argue, has reached the escape velocity, meaning that they have sufficient adoption, though I don't believe the trading fee at the moment is sufficient to sustain the project by itself. So what they're doing is they're emitting governance tokens when you as part of the rewards to the liquidity pools. And when you lock the governance tokens, you can choose the duration in which you lock the tokens. And the longer duration that you choose, the more voting power that you get. And the interesting part is it's a decaying process. So the moment that you lock for the longest period, you get the additional voting power, which then you can use to influence the project. So I think there is a huge correlation between how how well you want to influence the project versus how much profit you want to get by dumping or selling these governance tokens, right? And one interesting effect of that is bribery. And I know this is not the most beautiful word in the world, but essentially it's lobbying, right? the So there are essentially projects that have been built on top of Curve that exclusively deals with this type of voting because they understand, because once you lock the tokens, you're not able to move them. And in order to vote, you must be the one to cast the vote, right? You can't say, okay, I'll delegate to somebody else. Well, guess what? There are projects that want to get the liquidity incentive from Curve, but they don't necessarily have the capital to purchase these governance tokens. Now, that's quite interesting because that's essentially mirroring our government, right? You have the politicians that do the votes and so forth, and then you have lobbyists that go around and say, hey, this is probably the right vote to pick because XYZ, right? For DeFi, there is no human interaction, so it's very straightforward that you will pay these whales that are locked into Curve, and they vote on behalf of your protocols. So I think that's one, and there's a term for this, right? It's the V tokenomics, and I think it's probably one of the most effective way to kind of mechanize this entire ecosystem with governance token staking.
Yeah, Carl, I love that you took it there, especially with the government analogy, because you're right. So at the end of the day, Curve is making certain reward allocation disbursements based on this voting power, and those go to, in the government analogy, what would be different infrastructure pieces, right? Or even different private company sectors. So I think that's a super interesting model to point out because it really is, at odds with what I would call the old DeFi model, which is where you stake your cash, you get your reward mechanism, you dump it, right? Like immediately. Whereas with Curve, you are staking because you need to participate in X, and there is economic value to staking because there is economic value to voting, right?
Right. I generally think, some people, some community are onboarded into DeFi via philosophical reasons, right? But that only goes so far. For example, even if you can onboard the 1%, the rest of the 99% of the community needs to have an incentive to kind of go on the platform, right? Because then the question becomes, how do you design a protocol or a project so that people are correctly incentivized to perform the action that you desire them to perform, right? So for example, staking, you give them more voting power, and if your project gets traction, that's a huge amount of incentive, liquidity incentive that they can provide, and that's how you mechanize a sustainable ecosystem.
Yeah, I love that. And I guess, kind of bringing this out into the bigger picture a little bit, how does the presence of staking in a project or the lack thereof staking in a project, how does that impact, your decision to either invest in a project or participate in a project? Does it have any impact on that?
So Shima is a pre-seed and seed stage crypto native VC fund, right? And tokenomics design is critical to a project, whether it's DeFi or gaming, and we can definitely talk about gaming later. But as far as tokenomics design is concerned, staking is definitely one of the critical part of such design. Whether it's a decision to have staking or not, it has to make sense for the projects, right? So I would argue it's a case-by-case scenario. Some of the projects should have staking, and if we don't see that element in there, we would recommend to work with our in-house token designer to kind of work that in, right? Remember that tokenomics is also a living thing where, hey, just because it works today, it doesn't mean it will work tomorrow. So we highly recommend the portfolio companies to be flexible on the tokenomics, because as soon as you release the tokens, and assuming these tokens have governance capabilities, your roadmap is largely driven by the token holders, right? So when it comes to staking, it's not a key indicator for us, though it's definitely critical and to the health of the portfolio company. So it really depends. Some of the projects make sense for them to have staking and some of these don't. So yeah.
I think that's fair. Yeah, it really is a case-by-case basis thing, right? Because some projects actually generate revenue or they generate things that you could vote on. Other projects, like provide some piece of infrastructure service. So it's different. I totally agree. I think that's fair. I guess, staying on staking for one moment before we switch off to another topic, staking within games. Okay, this is a fun exploration, right? Because games are fundamentally different than DeFi projects and these other major blockchain infrastructure pieces that we see, because it takes in some social fabric, right? There's like participation from an audience. They come in, they bring in their value. Staking has a different context there. How do you see staking inside of games?
Yeah, I think it's hard to get it right. I think Sam, you and I had a conversations around the game tokenomics, and conventionally in Web2, I'm a gamer myself, right? You usually run into a problem. For example, I play Diablo series game quite a bit. The items you got and the amount of gold you had at one point might be considered top tier, and if you don't continue to participate in that ecosystem, you don't grind in the game anymore. Half a year later, what was considered top tier or elite tier is now completely irrelevant, right? And the amount of gold, and more importantly, the gold is essentially the token of the Web3 gaming, right? Becomes essentially worthless, right? Because there's this massive amount of one-sided inflation and so forth. So coming back to staking, I think it's for games, it's even more difficult to get it right because that the games always want the participants to continue participating, and what that ends up doing to the economy is that you need a way to issue more currencies in the game. And now, if we're talking about, hey, you stake the currency and then you will get more, then that just exacerbates into the whole the problem, right? So I don't think it's a solved problem today, though there are models where you have two token model. One is the governance token and the other token is the in-game currency. I don't know how effective that is, because even for the governance token, you run into the same problem. You have people stake. Now you have the DeFi project type of problem, right? The governance tokens get staked. They are the more valuable type of currency in the game, and the tokens and the interests are no longer aligned, because guess what? The gamers and the rest of the community are focused on the in-game currency, whereas I would argue people who usually hold the governance tokens are the developers and the investors. So we see a disconnect between the ecosystem and community versus the investors and developers. So as for staking, it's I don't think it's a completely solved problem, and sure hope to see more innovative solutions to this topic here.
Yeah, I think that's totally fair. In gaming, it just gets so complicated. You can stake NFTs, you can stake tokens, the utility token, the governance token. You have like 10 different routes to accidentally dilute your economy to zero. And it's we see mistakes made left and right, and it's not a lot of developers' fault, because the examples that we have so far in the space, there's really nothing that like works conclusively, right? We're still figuring it out kind of all jointly together. So I guess, as kind of a final tangent here, staking ultimately needs to support project value, right? So the devs and the project managers all have a responsibility to their project to drive value to that. With respect to project KPIs, right, do you see any particular KPIs that staking helps to support? Either that's user growth, marketing, anything. Is there anything that you see clever project managers using staking to support inside of their projects?
Yeah, I think for staking, one of the most misunderstood kind of the philosophy there is staking is not the end, right? It's a means to an end. Just like blockchain technology, it's not the end; it's a means to an end. Why was Bitcoin invented? Well, because it's not because we wanted to have a decentralized financial system. It's because we want to be people to really own the underlying asset with no restrictions, right? So for staking, proof of stake network, the end goal really is to secure the network, right? So for some of these projects, we really have to look at why do we need staking, and what is the goal in which we were using staking for. So I would argue some of the projects are tying governance and governance voting power to staking, these projects, at least today, tend to do better than the rest, where they're just blindly giving out rewards with no lock and with no requirements to kind of use these tokens for voting, right? Because if you think about this, DAO is being adopted everywhere, and some of the DAOs don't have the token, but a lot of DAOs do, and all the proposals proposed by the community theoretically need to be voted using the tokens, and based on how much tokens are in favor of a certain proposal, they get passed, right? And we're so early on in this field. A lot of, and the other thing is the token distribution, right? It's a misconception where, hey, a 1 year old or 2 years old project, people always claim, hey, the foundation owns 80% of the token. Well, that's because these projects are young, right? Imagine if we're bullish in this market and we're long blockchain, then we should look past the next 6 months, next year, or next 2 years. So we should think far ahead, next decade, when these projects have completed their distribution of tokens. We would imagine that it's somewhat a decentralized ecosystem. Sure, you get the whales on 1 or 2% of the system, rightfully so. They've been accumulating these. They have complete trust in the project, and rightfully so. They should get more voting power, right? But in the perfect setup, you should generally see a pretty good distribution of the tokens, right? And then that's when the staking comes into play. Is that, hey, like, it's one thing that you want to trade these tokens, but if you actually want to participate in this game, or you want to participate in this protocol, you must stake, get locked, so that you have a say, right? It's almost like a reputational thing. If you want to say something and you want to propose something, put the money where your mouth is, so that you show the community, hey, I'm not here just to tell you guys this is the right thing to do. I'm using my stake to kind of tell the community I go for it, right? So,
and Carl, I absolutely love that you ended on that, because it brings us full circle back to almost the first comment that we made during this chat, which is that staking started fundamentally as a way to support consensus mechanisms on a blockchain. And it seems that the direction that the community is taking is that ultimately we're going back to this method whereby staking supports the consensus method on an app. And so now you've moved it up from the consensus layer on the blockchain up to the consensus layer on apps. And that's a very legitimate use case, for staking.
Yeah, totally. And it's extremely dynamic, right? What is working today might not work tomorrow due to the immaturity of the ecosystem. So as VCs, we're always on top of the game, making sure that we see what's coming down the pipeline.
I love that. And that's also a good, kind of ending point here. And I'll ask you this and then ask if there's anything else you want to shout out here at the end. But, as an active participant inside of venture capital, what advice do you have, for these new Web3 builders, folks who are trying to put together their own projects and strike out on this? What would you tell them?
Yeah, I think definitely focus on product market fit. Just because we have the best idea doesn't mean that it will end well, right? We see many of the good ideas, as the chances are the ideas you thought of, someone else already has a better deck, and someone else has already executed on that and failed, right? So product market fit, and also execution, right? Because these days, execution is extremely important, because we're going through a massive adoption phase for blockchain, and whoever has the better user experience, whoever has the better user base, whoever has the better product roadmap and execution will ultimately win the game, right? So the advice really here is it's not so much about the idea. Sometimes the idea might not be so sexy, but there's no one executing on that idea, then go and build it. This is actually pretty funny, because if you notice, we have a huge, there's a huge hole that needs to be filled in the infrastructure layer, right? Hey, how do you visualize the data in blockchain, what they're doing? How do you make sense of these data? No one's building these. Well, some of the projects are starting to build these, but it's almost like, hey, we just want to get the money moving first and then care about the visibility later. And that makes sense, but currently there's a huge hole in the infrastructure layer.
I think that's again completely fair. Execution with an eye to user experience is gonna steal the show over the next couple of years, in my opinion, too.
Yep.
Carl, this has been a ton of fun having you on. I'm gonna give you a couple seconds here at the end. Is there anything that you want to shout out in general? Anything that Shima's doing, or any of your projects that you want folks to know about?
Yeah, we just completed our $200 million raise, and we're currently
Congrats.
hiring. Yeah, thank you. And we're also currently hiring 1 to 2 investment associates. So if anyone's interested, send us an email, and we'll get you guys interview.
I love it. All right, guys. Well, keep an eye out for Shima here. Carl, thanks a ton for coming on. This has been a lot of fun, and we will see you guys next week.
Likewise. Thank you, Sam. Take care.